let's dive in. All right, so I make use of, for many years, I've been trying to break through the market to get success with forex trading, but it has always been ups and downs. This works, it doesn't work, and things like that. But over time, I finally got a strategy. Then I went through a documentation that worked, and then I formed a strategy out of that documentation, and that is what we'll be looking into as a study guide right now. It's called the Candlestick Trading Bible. It's very, very good. And then this lecture might be a little bit lengthy, but it's going to be a life changing if you can hold on and then ensure that you go through this training with me. All right. So, and then you can see it's called the Candlestick Trading Bible. I stumped on it. It's purchasable. It's about $8 or $10 if you want to buy it online. So I came through it and then I went through it, and then it has really, really done something good for me. And then that is what I'm trading with. So we have some things in this study guide. I'm going to be showing you and then explaining how it works. So we're looking at what we call the candlestick patterns. That's what is the candlestick, how it works. And we will not be using everything. We're just picking the ones that we need and then we'll use it to form the strategy that works also. So we're going to be looking at the candlestick pattern. We're going to be looking at the market structure. We're also going to be looking at the time frame. We're going to be looking at the strategy. And then when it comes to the strategies and tactics, that's the one I said I will be giving to you my strategy that works, that gives me a high profitability, profitability in the market. And so we're looking at all these within this training. We have the taxes, and then we'll be looking at the different patterns. Some of you know, so I know these. I've gone through all this lecture, and still you lose money. You will not lose your capital if you follow this strategy that I'm going to be giving to you. You will not lose your capital. So let's dive into it and see. Let's just do a little introduction about the candlestick. The candlestick trading Bible is one of the most powerful trading systems in history. It was invented by the person called Omar Hisla. So, and then it has made a lot of people have made a lot of dollars from this candlestick. And then over the years, it has proven to be successful to those that understand it and can relate with it. So that's just the beauty about the candlestick and how it works. So we don't want to do so much introduction. If you even need this document, I am also willing as a package to send it to you personally. So right now, overview, we're looking at the candlestick anatomy. Just as human, candlestick have different body size. And when it comes to trading, it's important to check out the bodies of candlestick and understand the psychology behind it. So as I earlier told you, this is what makes my trade that I earlier shared with you. This is what gives me the profits. I'm using the full pattern. Just you can see my trade. I'm using the full pattern. I follow it, and then it has been successful. You can see it's always growing. Having 100,000 and then turning it into over 800,000. You will look at it. This is within 3 months. Within 3 months of trading, that's a high return on investment. So do not underestimate this trading. I just want you to go through, and then you're going to see how interesting it's going to come out. So, right. So let's continue with the candlestick document, and then I'm going to quickly pick on each one that you need. What you really need to know about it is what we're going to focus on. We're going to be looking at the anatomy. I said it's very good. So we're going to be looking at the candlestick pattern. The pattern is an integral part of technical analysis. We can't do without technical analysis. Candlestick patterns emerge because human action and reaction are patterned and constantly repeated. You might be saying, "Oh, the trade is not going in your way," and then you make a mistake. The thing is, the forex market has always been doing the same thing. The problem is just that you do not know the time that is going to repeat what it has done, maybe a year ago, or 5 years ago, or 6 years ago, or 3 months ago, or yesterday. You just don't know the specific time it's going to repeat itself again. That is the problem with the forex market and trading. So I traded with some brokers like of eToro or Forex and trading and some other ones like that. So and then I'm just using my my Forex account as an example. So the candlestick always repeats itself. Ups and down is the same in the market. You just don't know when it's going to be coming up and stay for it, or when it's going to be coming down and then sell out. All right, so the market structure, it's very important. In this section, you will learn how to identify trending markets, ranging markets, choppy markets. You also learn how this market move and how to trade them professionally. Then the fourth one is 4 times. There are different time frames. So we're going to be looking at those different times. So multiple time frame analysis is very important. You need to know which time frame is best for your strategy. So it's very important. So, and the thing is, you don't really need to combine time frame. Once you know one, maybe it's 1 hour, or it's 24 hours, or it's weekly. You just stick to it. And the fifth one is trading strategies and tactics. It's very, very important that you keep to that. So we'll be looking into, and then the sixth one is money management. So let's go in right now. We've looked at the history. We don't want to do so much. As Amelia said, if you want this material, you can buy it online, but if you want me to send it to you, free of charge as part of the packet to you, I can send it to you. You might just need to open, and then I'll send it to you in the right way, not in the comment section, but you need to. I'll communicate this to you at the end of this training. I will be giving out my successful trading strategy, and that's what I'm really into. But the thing is, I do not want to give you a trading strategy that you won't really understand. That is the reason for this training. So that's just the reason why we're doing trading training. All right, I want us to quickly start the what's it called, the candlestick. The permit can be formed using the open, high, low, and close of a choosing time frame. So what do we mean by choosing time frame? What do we mean by choosing time frame? So that is the question now. Time frame. So, and then that is what really matters in trading. So right now we'll be using this white candlestick as let's say we call it bullish. That's when the price is going up, and then we'll be using this black as the what's it called, the bearish when the price is falling. So right now, if you look at this candle, whenever you see this candlestick, let me just show you this candlestick in my in my trading MT5 trading account again, so you can understand what I am displaying to you. This is what I'm displaying to you. Here I'm representing the white as my bullish, and as my bearish, and I'm representing this black as my bullish. It doesn't really matter. It depends on the color that you want to use. So I only adjust colors and then make it like that. So this is a candlestick. This is a candlestick. This is a candlestick, and all these candlesticks, they have a meaning. This is a live account right now. You can see the prices are changing. This is a live account right now. So I'm very conscious of what I'm doing, because I do not want to use demo to teach. I want you to see what is really happening real life using a real life trading account. All right, so these are candlesticks. So let's quickly go back and then continue from the tutorial, from the manual itself. All right, so how do I know when to buy? How do I know when to sell? That is what I want to look into. The real body, this is a body, and then we call this place the upper shadow. This line is called the upper shadow. This line is called the lower shadow. The center, it's high. This is closed. This is open, and then this is low. What is the meaning of this is what I want to explain now. So just bear with me while we understand it together. This is upper shadow. This is lower shadow. The trade, this can be, let's say, at a daily time frame, or it can even be a 1 hour time frame. It can even be a 5 minute time frame. So candlestick can either be 5 minute time frame, 30 minutes, 1 hour, 24 hours, and that's daily, weekly, and so. So let's say this is a daily time frame, 24 hours. One candle is formed in 24 hours. What is the meaning of this right now? If the close is above the open, we can say that the candlestick is bullish, which means that the market is rising in this position, in this period of time. All right, the bullish candlestick are always displayed as white candlestick most of the time. So this is a bullish candlestick, meaning that the price increased. How did we know that the price increased? The price opened at this level, the price started at this level, and then it closed at this level before the time ended, before 24 hours. After 24 hours, this was where it was at the end of the 24 hours before starting another one. But what is this and what is this? When the market opened, when the day opened at this, the price jumped at this. The market the price fluctuated, went up, got here, came down, maybe went back down, and then stopped at this place. Then started going back up again. It started going back up again and got to this place. This place is what we call the eye level. This is the highest price at which the currency pair or the trade got to. It might be, let's say, gold. It might be EU, Euro USD. It might be JPY USD. So it can be any currency pair, or it can be metal. It can be any other. It's different. It can be stock market, stock. It can be Apple shares or anything. So you can represent it with any of these candlesticks. So now the price started at this, and then it closed at this. But it got to this place, then it dropped down. So now the opening price is less than the closing price, meaning this place has a higher price compared to this. So when you see something like it means that the the price has increased. For instance, if this was, let's say, 100, and then here is now 120, you can see that the closing price of that commodity is now 120, meaning this candlestick for this thing is a bullish candlestick, meaning that it was profitable, it when the price increased at the end of the day. So that's just what it means. Despite the fact that it started there, it came down, it reduced, but it did not close at that day at this level. It still went back up and then closed there. I hope I'm not repeating myself. The only reason why I'm trying to say this over and over is once you understand the meaning of the candlestick, you are done. That's the basics of everything. Once you understand the meaning of this candlestick, you've gotten the fundamental. That's it. Okay, let's look at this right now. This is another candlestick, and then it's represented in black. Say the market opened at this price for that day, for the new day. It started at this price. Maybe this was 120, and then when it started at this price went up. It became bullish for some time, and then when it got here to the highest, it started dropping. And it dropped below the opening price. It got here, it continued dropping, and it got to the lowest. When it got to this peak, it came back up a little bit and then ended the day at this level, meaning that the closing price is less than the opening price. Whenever the closing price is less than the opening price, is a bearish market, meaning that the price dropped. The price of that specific commodity or that stock or that currency pair dropped. It started at a higher price, but it closed at a lower price. That is just all what you need to understand concerning what is a candlestick. I hope you get it right now. So let's move. Let's move to the next explanation. Now you can find different colors used. You can see that's what I'm saying. You can use different colors. So and then candlestick have different body sizes. That is what you want to look at right now, which is called the candlestick body size. So what really happens with this body size determines if you are to buy or to sell. Now, if you look at this, we are representing our candlestick that is white as a bullish candlestick, and we are representing the black as a bearish candlestick, meaning the price came down, the price went up. That's the meaning of bullish and then bearish. All right. Now, if you look at this candlestick, you see it's very small. Imagine throughout the day, the market there was low time, so there's less activities. There was no news that was urgent or things did not just happen unnecessarily. So the market was just steady movement, or it was a dull day, and then but the price went very high. So there was the change in price was drastic, despite the fact that it's still the same time frame. This 24 hours. If this small one is also 24 hours. So now if you look at it, this is small, this is big. The same thing too with this is small and this. It doesn't really matter. It's the same hours, but activities was different during those times. So long bodies refer to strong buying or selling pressure. So what does this mean? When you have this long body, it means that there was strong buying or strong selling. A lot of people, a lot of pressure in the market, for buying or selling. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during that time. So which means that because there's one thing with the market, it's all about buyers and sellers. Two different set of people with different opinions. So lots of people are saying some people are buying, some people are saying they don't trust this stock and they are selling. So whenever there's more people buying, then the market is going to be volatile. There's going to be pressure on the price, and then it's going to be drastic. So, but when there is more people that are selling off their shares, selling off their stock, then it means that it's still going to be volatile. But what's going to happen is that there's going to be pressure and the market. So that's what forms something like this. But conversely, if it's a bearish candlestick in which the open price is above this, the same thing. It's just the other way around. So, but now, what if this is happening? It means that there's less competition between the buyers and sellers. So, which is there's no drastic buying and there's no drastic selling. That is just what I want you to understand about why some candlesticks are long and why some candlesticks are short in size. So, let's quickly look at another area that is important, which is long shadow. So, this is very important. This is what we call shadow. Imagine you have a small part of the opening and closing. This is for this now, this is the opening, and then this is the closing. This is a bearish candlestick. But if you look at it, it has a very long tail. We usually call it tail. So we call this shadow. So whenever this happens, it shows that there's another strange stuff happening in the market. It says if a candlestick has a longer upper shadow, this is the meaning. If it has this longer, it indicates that most of the trading action was confined near the open and closing. The action were confined here. But of the reason or another, sellers came in and drove price back down to end the section back near the open price. For instance, the market opened at this top here, and then something happened. A lot of people buyers, they started pushing, but it came to a time the pressure from the sellers was greater than the buyer, and they dropped the price back down below. But something happened when the sellers dropped the price to this level. The buyers did not have enough pressure to push the price back up. So at the end of the day, the price ended at this level. So that's what formed this kind of candlestick. It's the reverse to this. What happened here was that, okay, the market opened at this, but the sellers were stronger. A lot of people were selling out, getting out of the stock. So it was dropping the price. So, but it got to a point when the price go on, the buyers came in and they believed in the stock and they started buying more, and then they started pushing the price back up. So, and then the sellers could not overpower or overshadow the sellers anymore, and then that is why the price of the commodity was not higher, but it was very small. So in this manner, we usually call this kind of candlestick. It has a name. In the course of the lecture, I'm still going to tell you what each of them means, the name. So just go. Let's continue together. I hope you are getting something. All right. I also want to say, if you have not subscribed to my channel, this is the right time to subscribe to this channel so that I can you can always get notification concerning trainings like this, and then you can be much more better and comfortable when it comes to trading. All right. So please subscribe and then click on the notification button if you find this training interesting. All right, I want to tell you a little bit story about the person that wrote this. You say, I personally trade candlestick pattern for more than 20 years. I can't really switch to another method. That's just it. Right now, it's the same thing with me. I can't switch to another method. It's just fantastic. If you are looking for a 100 winning system, I highly recommend you to stop trading and go look for another business. There's one thing in trading. You cannot always have everything. You cannot always win 100%. That's the same thing. If you look at my stock that I earlier showed you here, you will notice that even in my trading, it was not 100%. There was a time I lost. Here you can see this was a loss. The market was not predictable as of this time, and I ended up losing. So you cannot always have 100% in your trading journey. So, but you should have more success than failure. All right. So engulfing bar candle pattern. Want to look at something interesting. Another type of candlestick. This is another type of candlestick that we need to take into cognizance, which is it's called engulfing. Engulfing means when something overshadow another thing. So that's just the meaning. So if you look at this, there are two candlesticks right now. This is day one and this is day two. On day one, it was a bullish, but on day two, it was a bearish market. But there's a difference. If you look at the candlestick of day one, it's a small one. It has a small body. But the candlestick of day two is longer, and there's something happened here, which is if you look at this, the starting of the day two and the ending of day two, it's the day one is between it, which is within it. So it means that day two engulfed day one. It swallowed. Let me just use that language. It swallowed day one. Meaning, so when you see something like this, it's called bearish engulfing bar. Bearish engulfing bar. So that's, and then this is trying to tell us something, which means that the sellers are very strong, meaning the next day, which will be day three, the market is likely going to continue to decrease in price, which is the sellers are going to continue to take charge of price, meaning the third day is likely going to be the same flow like this. So do not buy, but sell. That's just the meaning. All right, so let's continue. Now, this is a typical example. This is a typical example of a trading pattern. See, the market was going. All right, you can see it got to this place. You can see this small candle, and then the next day, the price dropped drastically. Meaning this engulfed this. It's totally inside this. So now, see what happened the next day. it dropped. See what happened before day, it dropped. So, but peradventure I had gone on this day to go and do a buy, I would have lost in the market. So whenever you see something like this, is a time for you to what? To sell. It's telling you to sell. That's it. All right, I do not want to draw so much on that. Now, let's look at the bullish aspect of it. The bullish aspect of it, for instance, this, if you look at this, it was a sell trade, it was a bearish trade on day one, and on day two, it was a bullish. But if you look at the bullish day, it swallowed or it engulfed this, meaning this place to this place, this guy is inside it. So it's called a bullish engulfing bar. What does this really mean? It means that the next day, you are supposed to what? Buy. The market is going to continue to go up. This is an example. You can see this bearish candle and this bullish candle. This bullish candle engulfed this totally. This means that if you want to take your trade the next day, or you want to decide whether to stay in the market or leave the market, whether to buy or sell the next day, is going to tell you that the market is going to continue to go up. And then this, you can see this is what happened. This is what happened. If you look at it, this was one of the examples we took before. This was totally engulfed. You can see it a little bit having a situation here. So this is called a bullish engulfing bar. It tells you what next to do. It tells you what next to do, and that is how you decide on the next trade that you should take. Now, let's look at another type. Let's look at another, which is called the doji candlestick. The doji candlestick. You can see this usually forms something like a cross. It's just a cross. It's called doji. This means that the opening price is the same thing or almost the same thing as the closing price, which means when the market opened for the day, the price went up or it went down, but it ended the day at almost the same price at which it opened for that day. So we call it doji candlestick. And then what's the impact of doji candlestick? It's telling that it's now time to change. That is likely that the market is about to change. So that's just the meaning. If you look at it, so the price of these candlesticks were in the bullish. It got to this place, it formed this, meaning do not expect the market to continue to go in a bullish pattern, meaning it's going to drop. And you can see what happened. It started dropping. So these are the signals that you're supposed to be looking out for in most of this trading stuff. So you are not just supposed to trade without looking out for these stuff. All right, so let's look at another pattern, which is the dragon doji, or I call it dragonfly doji. So this is when it has a T. When you see a candlestick that is a T, that's in a T shape, it's telling you something, which means the market opened, but the buyers were not able to push the market. They were not able to push the commodity price higher, sorry. So, but the seller's pressure was high and they dropped the price down. But before the end of the day, the buyers were able to force the market, the price back up, but there wasn't enough pressure from the buyers to push it higher than the opening price. So that's why this was formed. And then what happens when such happens is this. It's trying to tell us that, you can see this is a T here. It's trying to tell us that the buyers have a higher pressure, and then there's a likelihood that they will continue to push the price higher, meaning this is a good time to start buying. That's just it. If you were selling before, get out of the sell trade and then buy. So it's just trying to give us a good pattern and giving us a scenario whereby we need to start buying. You can see when this was dropping, the market has been dropping for several days. And then when it formed this, see what happened? It started going back up. That's telling us that the pressure of the sellers is coming to an end, and then it's likely that the buyers are going to take control. So this is a signal that you need to look out for. So when you see a dragonfly doji, it's trying to tell you that stop selling, it's time to decide to buy. All right, so we have we call it a gravestone doji. Gravestone doji. So it's the opposite of a dragonfly doji. And then what this also means is that the opening price, the seller, the buyer's pressure was very high. They pushed the price to this level, but the seller later maybe there was a news or there was a situation that happened, or different things can happen. And then the sellers pushed the price back down, and then it closed for that. Meaning the sellers are still in charge of that specific commodity. They still have a long pressure. And then what happens when this occurs? You can see what happens is, you can see this trade. It was a bullish trade before the gravestone doji showed up, and then you can see what happened. the price started coming down. So when you see something like this, it's a signal that the price is likely going to start going down. It's going to start going down. All right. So let's look at another one quickly. We have the morning star. The morning star is a combination of three. It's a combination of three candlesticks. This is day one, day two, day three. Will form your decision for day four. In day one, it was a bearish candlestick. The sellers were in charge. In day two, the sellers were still in charge, but the pressure was not high, was not much, but they were still in charge. Day three, the buyers took over. The price of the commodity went up. So it now formed a three candlestick. This is a big one, this is a small one, and this is a bigger one. When you see this three combination, it means that on the fourth day, continue to buy. That is just the meaning. You need to continue to buy. It means that the market has changed its course, and then the buyers are in charge. It's going to continue to be a bullish market. That's what that signifies. So let's look at it in an example. If you look at it here, you're going to see this. The price has been dropping for some time, and then now it formed this. It formed this little candlestick, and then it formed this. So the combination of these three means that the trend is changing, and then you should be getting ready to start a bullish order. You can see. So that is these are things that you look out for. These are things you look out for when trading. All right, and then we have the evening star candlestick. This is the opposite of the previous one. So we can always see this. Let's look at an example of this so that we can quickly and also so you can see this, the evening star. The market was formerly in a bullish trend. The price was going up. That's just a minute. And then it got to this place. There was this candle, and then there was this bearish little candlestick the next day. And then again, the next day, there was now a long bearish candlestick. So when you see these two combinations, with this third one, it means that the market is changing, that the trend is changing. And then you need to change your decision. Is either you want to sell out here and keep your profit, or you want to close your trade, or you want to start a new sell trade. So this is dependent on what you decide to do next. All right, so now let's continue quickly. All right, so we have something that is very, very important. No matter what we do, I can't forget this, which is called the hammer. I call it the pin bar. It's very important when we are dealing with candlestick. You can see, but this right now is not a T-shape. It has an opening and a closing. It has an opening and a closing, but it's a small pressure opening and closing. So if you look at it, it has a long shadow, meaning when the market opened at this price, the sellers pushed the price down, but they weren't able to sustain the fall. So the price went back up and a little bit above the opening price. So the closing price was a little bit above the opening price. So when you have this, it's like an hammer. So when you see something like an hammer, it's called an hammer or a pin bar. And then what happens? Let me show you. So you can see, for instance, if the trend was a downward trend, a bearish trend, whenever you see the pin bar or the hammer, it's telling that the buyers are now in charge. There's more pressure in the market when it comes to buying. And then the next day or your next decision is to follow the trend to buy. Is to buy. You can see, is to buy. You can't continue to sell whenever you see a pin bar. Whenever you see a pin bar, you cannot continue to sell. You have to start the other way, or you sell out. Get out of the market if you're not sure. All right, so that's for the pin bar. And then this is opposite of the pin bar. You can also call it bearish pin bar, or you can call it a shooter star. It's just the opposite of the pin bar. So if you look at it in this context, you can see the price was in a bullish, and then there was a shooting star or a bearish pin bar shown. It means that the price is about to start to drop. The seller's pressure is more than the buyer's pressure. I'm trying to use a layman words like for beginners so that they can understand these, because this course is mainly for beginners and then intermediate traders. So all right, now don't forget to subscribe so you can get more of this trading material, and also helps YouTube to also push this trading to other people that might not have seen it before. All right, so, and also, as I've earlier said, I am giving you my strategy at the end of this training. So please stay to the end so that we can discuss about the strategy, because understanding the candlestick mechanism is not enough. You need to make use of some other things as well. All right, so now we've discussed that. So we have some other ones. The RME, I wouldn't want us to look so much at the RME because I don't usually use it most of the time. And also the tweezer bottom and the tweezer top, I don't also use it most of the time. They are good, but we can do without it. All right. So let's look at the market structure. The market structure quickly. In the market structure, one of the most important skills that you need as a trader is the ability to read the market structure. It is critical skill. It's a critical skill that will allow you to use the right price action strategy in the right market condition. Okay, the truth. We have different market structure. We have the trending market. We also have other forms of markets. So I'm going to show you. Let's also look at the trending market and how do we know that a market or a stock or a commodity is riding as a trending market, either an uptrend or a downward trend. All right, look at this right now. This is a chart, different candlesticks, or let's say for each day. If you look at this market, you can look at it for, let's say, a year ago, or let's say 6 months past, or 2 years past, and let's see how it has been moving. You look and you see it's downward, upward, downward, upward, downward, upward, downward, upward, and so on and so forth. So here, whenever it goes up and then start coming down, we call it the higher highs, and then whenever it comes down, we call it the higher low. Higher low. When it goes up, higher high, we're exchanging higher low, higher high, higher low. But why do we now call it upward trend? If you take a straight rule across everything, you're going to see that the price has changed. The price here is greater than the price here, meaning it's an upward trend. This is an upward trend. But let's now take a look at a downtrend market. So don't forget, this is a trending market. So we have two different trending markets, upward trend and downward trend. If you look at this, it came to this high, it came to this, we call this the lower low, and we call it the lower high, the lower low, the lower high, the lower low, the lower high. But what we are really after here is the change, the point of change. If we draw a straight line, you see that the market, the price it was here is higher than the price that it is right now, meaning the current price is lower than the past price. You understand? So the historical price. So now this is a downward trend. So it's part of what you need to really understand and then know when to take decision or to even decide. There are some market structures that I don't trade in because I don't feel comfortable about them. But when it comes to upward trend and downward trend, those are part of the ones that I usually trade in. All right. So now, how to trade trending market. So there are different ways to trade trending market, and then it's pretty straightforward. You have to draw a line. You draw a line, a straight line to the past, and then you only buy and sell. You decide to buy at the lower high. This is a downward trend. Let me now explain what I mean by that. If this market, for instance, if the stock market for Apple or Microsoft has been coming as a downward trend. Now, here, I have to sell. And when I see that it has gotten to this place, I decide to buy. When it has, so you have to draw two lines for trending market like this. You draw a line, you draw a line here. So whenever it cuts across those lines, you decide to either buy or sell. It's pretty straightforward and simple. But one thing that I'm going to say is, the more you trade, the better you become. Sometimes you might not even be able to explain, but you just know what to do. All right. And the same thing, this is a real live chart. You can see what's happening here. This is an upward trend. This is an upward trend. You buy at this, you buy at this level, you buy at this level, you buy at this level, you sell 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 at this level, and so on, like that. Excuse me. So if you now want to decide whether it's time to get if this place is the higher high, you need to form a line from here. It's a straight line. If it hits this line, then it shows that it's time to change. So I would say it's straightforward. The same thing with the downward trend, how to draw the trend. So I've also explained this. So I said you have to draw a line. So it's the same thing you're looking at here. And then the same thing too, you have to draw a line down. So now that is for trending market. We have another kind of market which is called the ranging market. The ranging market, if you look at it for a period of time, you see that, let's say you look at a chart of 1 year, and then you see something like this, you end up saying that, oh, the market has just been going, the price is still relatively the same, you can see, but the market has just been going up and down to almost close to where it was before, up again, down to that place, up again, down. Really, it's not going like this. Neither is it going like this. You say the price is not changing. But instead of that, it's just going up, coming to the same place, going up, coming to the same place, going up. So this is what we call the ranging market. You have to be careful when trading in the ranging market, because you need to know when it has gotten to the higher high, and when it has gotten to the lower low. Here, so that's where you need to draw a line to specify that, and before you take your trade. So it's a simple here, and then this are called. There's something you need to also know, which is called the breakout. In trending trending market, in ranging market, there's something that you need to be careful. Something you need to be careful, which is called the breakout. Sometimes you might be trading and then you think it's a ranging market, and then you see something, instead of it to come down, it stops coming down, and then it keeps going back, or it keeps going up. Then this place is what we call the breakout. This is where you lose. And then if you come back to this place, so to my live chart, my live account, what is my live account? That was what happened here. We were able to pick the breakout, and then it was a loss. Like this now, if you look at this market right now, this is a market of, is this May? Yeah, this, yeah. Look at it, this market is likely a what? A ranging market. Is a ranging market. It's coming from where it is, it goes back up, comes down, goes. So that's for this. If I change the chart and then increase the time frame, it might end up changing to a trending market. So, but right now, what we are looking at right now is really not a trending market, but a ranging market. I just wanted you to see from a live account how, and you can see that the price is changing too. So it's not, and it's not a demo. This is not a demo. I don't really train people with demo because I don't believe it's real. All right, so we've looked at this. There's one market structure that you should never trade in. Never trade when the market is in a choppy market. Choppy means the market is just doing like, it's not really, you can't really say whether it's trending or is ranging. It's called choppy market. Just get out of the market and wait until it changes its structure. Do not trade in the choppy market. All right. Time frame. Want to look at time frame? We have different time frame. We have the 1 hour time frame, 5 minute time frame, 4 hours chart, and so this is what we really mean by time frame. All right. So the market structure. We've looked at the previous candlesticks, the market condition. Look at this. Let's this is a live one weekly chart. This is a weekly chart. From a weekly chart. All right. So let's look at the strategy. All right. Now, there are some things you should take note when it comes to strategy. Strategy is what makes you profitable, not the fundamentals, not the technical analysis. It is really the strategy. And then the strategy is all about what are the combination of things you look out for when trading. The combination of things you look out for when trading. That's what we mean by strategy. So because you see a pin bar, and then you see, let's say, a pin bar, a bullish pin bar, and then the next thing is for you to buy, you might end up losing your money because that is not enough decision for you to take. It's not enough point for you to take a decision, if I'm correct. So you need to have some combination of things that you look at for. Check. We call it checklist. If this is this, you check it. If this is this, you check it. If this is this, you check it. And then once about that 5 are checked, and then they are even, they are correct with the, so then you go for it. When 1 or 2 of those checklists is not even, you leave the trade. You don't trade. You don't trade that stock or that commodity or that crypto, any form of currency. You don't. So it's very important for you to know this. Okay, the first one is you know how to identify the market trend. We've already looked at this. One of the things you need to look at in the strategies, you need to know how to analyze the market. What type of trend is this market? Is it a ranging? Is it a dropping? Is it a trending market? You need to know that. The second one is the second aspect is the level. You learn how to draw support and resistance level. It's very, very important for you to know how to draw. It's one that ranging will be like this. So those are, you need to know how to draw those lines to decide the lower low and the lower high and the higher high and the low and the higher low. So that's the second thing you need to look at. The third one is the signals. You have different candlestick patterns. This is the pattern, and then this pattern is psychology. So you need to just know that this is a pin bar. This is a engulfing bearish engulfing bar and things like that. So you need to know each and every one when and how it's happening. All right. This is a ranging market. You can see. So this is a ranging market. They say the illustration above shows us 3 trading opportunities. Let me explain you how you can trade them successfully. One, the first one is a pin bar. This is a pin bar. You can see pin bar rejected from the support level. You can place a buying order after the pin bar. You can see this is already the price has already gotten to the support level. Then a pin bar now showed on the support, meaning that the price is ready to start going back up. That is the meaning. It has gotten to this support level. Meaning it's time for it to start going back up. That's one. One reason. Your stop loss should be placed above above the support level. That's your stop loss. So it should be above this support level. So we have the 2 areas that I didn't touch with. I'm just going to say 1 or 2 things because there's your entry price, there's your stop loss, and there's your take profit. Your stop loss is how much you are willing to lose, and your take profit is how much you are aiming to get. So your stop loss must always be even, and then this is part of the things that I'm going to give you in my strategy. My strategy is very simple. The reason why I have been able to craft out a successful strategy is because one, I see myself as I'm kind of busy. I can't stay in the market from morning to evening. I have other things I'm doing. I'm committed to some work, to work and things. I have a family. So I live in Europe, and then in Europe we can afford to be lazy. So and now I cannot stay on or glued to my computer every day. It's not really going to work for me. So what I end up doing is to strategize a plan, a strategy that works for me. That once I've taken the trade, I just go on with my daily activity, and then everything is set, and that's up. There's a specific time that I take the trade. There's a specific type of trade that I take. So, and these are all that I look out for. You successful is the strategy, not the fundamentals, as I've said. So you need to look at your time frame that you're going to be using. Are you going to be trading daily? Are you going to be trading weekly? Are you going to be trading monthly? Are you going to be trading 4 hours or 1 hour interval time frame? The next one is your currency pair. What type of stock do you want to trade in? Are you going to be looking at currency pairs? Are you going to be looking at stock? Are you going to be looking at metals? Are you going to be looking at commodities? So you cannot trade everything. You need to specify which one you plan to go for, and you have to stick to it. Another one is your lot size. What lot size are you going to be using? Are you going to use 0.01, or are you going to be using 10% of your capital and things like that? So that's another one. Your stop loss, your entry price, your entry time. What time are you going to enter the trade? So your take profit, and then your equity. How much capital are you going to have? Are you going to be putting in your trading account, the broker account to trade with? Because your equity will determine how long you can stay in the market when there is a drag down against you. So all this is the combination of what you need to use as a trading strategy. And there have been a lot of trading strategies that never worked. A lot. Never use a trading strategy without proof. Like, that is why I am not teaching you without proof. This is a live account. You can see this is my profit. You can see this is what was deposited. You can see this is what has been withdrawn. You can see what is left. And then this is also calculating the profit. You can see if it was negative, it's going to put a minus in front of this place that I have not made any profit. You can see. So don't use strategies that you don't know. And then this is where it comes in. I'm going to be giving out my strategy to you if you are new in trading, and then you don't have so much experience about it, or you are intermediate, or you've been trading very good, but you need a working strategy. You need something that you can just do and then go on with your daily activity, because there's one other thing that you need to know in trading, which is you can't concentrate on trading alone. You need to do some other things. Some people have asked me that, can I just continue trading and then quit my job and then focus on trading? And no, I will always say no, because the reason is there are ways you can trade, and then it will not affect other things in your life. So it's part of what they call the work-life balance. So, and then this is my own strategy. It gives me that I just press it within. I don't even spend more than 30 minutes, and then that's all. I go on my life. So, and then the result comes out. The result comes out, and majority of it is profitable. So I give people this my strategy, and I do not send it to you. What I do is I have a one-on-one meeting with you. I have a one-on-one meeting with you where I tell you the strategy, what you need to do, and this and that. So I explain everything to you, and then you note it down, and you have it. So I do not share it online, but I give it individually. So if you're interested in the strategy and you want to use it, you want to have a meeting with me, one-on-one meeting with me, via a call. So you can have that opportunity. There's a link in this training guide. You can go to the description, or there's a link scrolling. Just get the link and then book an appointment with me. So once you book an appointment with me, then we'll discuss, and I give you. Giving it, I've already said it, there is no price tied to it. It is free, but for you to book an appointment is what you need to do. That's where you need to be committed. But for you to get it, it's free. During the session, I give it out. So, and also, there's also this opportunity whereby if you do not want to trade because you are busy, but you want someone to trade on your behalf, it's called copy trader. Copy trader, what does that mean? Which is, for instance, I trade, and you do not want to trade due to the fact that due to your experience, but you do not also want to give anybody your money, because I will always advise anybody, do not give anybody your hard-earned money to trade for you. Do not send money to anybody. You need to have a broker of your own. You need to deposit your fund, and you need to trade. You need to see what is happening to your trade. So what I do is, from my own account, you can follow my account. So once you follow my account, whenever I enter the trade, whenever I enter a trade, automatically it triggers your own trading and enters the trade. When I close the trade on my own trading account, it automatically also closes the trade on your own account. So if I profit, you profit without you having to do anything. So it's called copy trade. So which I usually offer. So if you're interested in the copy trade, or you're interested in the strategy, you want to get the strategy and then use it by yourself. So book an appointment with me, and then I'll give you this one-on-one in the meeting like this. And you have the third opportunity is you can also ask your question directly. You can ask me questions directly, and I'll be able to answer all your questions. So those are the three reasons why I usually book an appointment for people that have gone through this training and then are interested to go forward with trading. So those are the three. So the link is there. Actually, good for you to click on the link in the description of this video, or you can see the link scrolling, or if there is a QR code also, you can try to scan the QR code, and then you book an appointment. You will see the calendar is booked, and then I will get it, and then at that specific time you get a link, and then we discuss. That is how you get it. So we discuss, and then you have all these things. During the discussion, you should know that there is no money tied to it. So during the discussion, once you have been able to successfully book an appointment with me, whatsoever happens during this discussion is 100% free.